Hello, and welcome to the third quarter 2024 video review of the iSectors Global Allocation models. My name is John Koch, iSectors Senior Investment Analyst, and I am joined by the CEO and CIO of iSectors, Vern Sumnicht. Vern will get us started with a quick overview of the global allocation models in case you aren't familiar.
Thanks, John. Yeah, we haven't talked about our global allocation models very much. There's 5 target risk models, everything from income-based models to the aggressive growth, the conservative, moderate, etc. But we've got some unique things I think about our iSectors models. These are mean variance optimization models. The equity growth balanced, conservative, fixed income. And they are the lowest cost models in the iSectors suite of models. And John's got some interesting information on the uniqueness of our models, why they're different than a lot of other firms' models. And I think that changes we've made recently to reduce some of the banking and debt risk and some of the dollar, foreign exchange risk that he wants to explain. I think you'll find it very interesting. John, you want to continue?
Yes, thank you, Vern. So like you mentioned, these models really are only models with any meaningful exposure to countries outside the US. So this gives us a nice opportunity to relay some of our thoughts about international markets that we otherwise don't get to talk about very much. So we'll start with going over the changes we made last quarter to the equity portion of these models. So we increased the raw international exposure in the equity portion of the models, while at the same time decreasing the foreign exchange risk of the model. And you might ask how we did that. If we increased the international exposure, how do we actually decrease the foreign exchange risk at the same time? Well, we did this through the use of a currency-hedged international dividend growth ETF. You can see on this chart that there are 2 versions of the same ETF plotted here. One is the normal WisdomTree International Dividend Growth ETF, the blue line, and the other is the currency hedge version of WisdomTree's Dividend Growth ETF, the red line. You can see the currency hedged version has outperformed over the last 5 years, mainly because the US dollar has been so strong relative to other currencies. But that's not the only reason that we wanted to add a currency hedged ETF to the model, not just because of outperformance of the dollar. Really, the more appealing part of this currency hedged ETF is the reduction in volatility that it provides. So you can see here, these are the drawdowns charted of the unhedged version of the fund in blue versus the currency hedged version of the fund in red. You can see that the blue drawdowns are much larger than the red drawdowns. The unhedged drawdowns are much larger. The volatility is much greater in the unhedged version of the ETF. And whether or not the US dollar continues to maintain strength versus foreign currencies, the reduction of volatility that the currency hedged ETF exhibits is a welcome addition to the portfolio and should help to increase risk-adjusted returns of the models going forward, even if the dollar does not remain dominant, although we think that it might.
Yeah, I think to be clear, we think that it will.
Yeah, to be crystal clear. Exactly. Thanks, Vern. Other changes we made to the equity portion of the global models, you can see in the last 2 bullet points on this page. So we increased our overall exposure to emerging markets, but we decreased the China exposure within that sleeve by adding an ex-China emerging market ETF from Colombia. We didn't completely exclude China from the emerging market sleeve, but it's about 50% of that EM sleeve. So it just really tamped down the China exposure to be much underweight what a lot of the other EM benchmarks are in the market. We also decreased our exposure to European banks by buying iCow from Pacer, which is a developed international free cash flow focused ETF that explicitly excludes the financial sector. Many developed international equity indices are more heavily invested in financials than their US counterparts. This presents a unique challenge because banks overseas are disproportionately leveraged compared to US banks due to differences in their reserve requirements. By adding iCow, we increased our underweight to financials versus the MSCI All Country World Index. Essentially, we just are even more underweight financials than we were before we made these changes.
Again, the reason is that we have a little concern or a lot of concern about the developed international banks. They're much more leveraged. They have lower reserve requirements than we have in the US. And for example, they can use derivatives as a part of their reserves. Again, that does not happen with US banks. So there is concern about the developed international banks, less concern actually about the emerging market corporate debt. They don't have as many financials in their corporate debt, and they're commodity based, which we think in a period of inflation gives us additional protection. I'm sorry, John, go ahead.
No, exactly. I was going to hit on that. So that's one way we increased our non-US exposure in the fixed income portion of these models. Because we did the same thing in the fixed income portion as we did in the equity portion, where we wanted to bump up that international exposure without taking on more foreign exchange risk, which we did because all the bonds within this global fixed income portion are primarily US dollar denominated. But touching on your point, Vern, what we did, we added EM corporate bonds to the fixed income portion, which is one way we increased that non-US portion of the model. So given that we have conviction on emerging markets on the equity side of things, it only made sense to add a small portion to the fixed income side as well. And like you said, Vern, EM companies and EM corporate debt is more commodity backed than the service driven developed international countries where they're much more leveraged, like you said, much more driven by financials and derivatives. So we felt comfortable adding EM debt to the model. If a global financial crisis does occur, the EM bonds, because of that commodity link, should at least be partially insulated from any sort of financial crisis because of that tie to commodities. So we'll end the global fixed income discussion here by showing the returns of the iSectors global fixed income allocation, net of strategist fees, in blue, versus both the Bloomberg US Aggregate Bond Index in black and the FTSE World Government Bond Index in yellow. Over the last 5 years, global fixed income has been able to outperform both of these indices with less risk and drawdown, partially because of the US dollar denomination that we talked about, and it has had a slightly lower duration than both of these benchmarks as well. If you'd like more information on this model or any of our other strategies, please visit our website or give us a call. You can see our contact information here, and we'd love to hear from you. I hope you have a great day, everybody.